Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. I am Paul Winkler. Mr. Evan Barnard here with me as well, which is, it was a pleasant surprise to see him walking there. I was like, I didn't know you were coming. If I knew you were coming, I would bake a cake.
Party crasher, wedding crasher,
I love it.
Show
no,
crasher.
It's awesome, man. It's awesome. It was a week and a half to remember. Oh my goodness. I don't know. 10 days for us without power.
Yes. For you, I was fine.
For me, yeah. Well, I got it back literally on Wednesday, which was just in time for me to go on News Channel 5 Plus. Yeah, I was on there doing my, the open line. And it was like the first shower I'd had in a week and a half. I was so happy. It's like little things, man. Now little things make me happy. And that was one of the big deals, is just getting our power back. And I had huge thanks to the mayor of Goodlettsville. He was rusty. He was fantastic helping us out. And
oh, good.
Oh, yeah. It's like, to have a mayor to actually go underneath your house to help find a leak. And go and help out with, it was just like beyond the call of duty. And boy, I'll tell you what, it was really, really good to get back online again, because it was a rough week. So open line, we did something. I'll probably get to this later. I'll talk a little bit about it later. There was a couple of questions that came up on open line that I thought that were kind of fun to talk about. But there were a lot of things going on in the financial world this week, of course.
You might say.
You think?
So
what was on your radar screen?
No,
Go ahead.
all kinds of stuff. I have to share. I was talking with Cindy this morning, and I said, I bet the first thing out of Paul's mouth is going to be, boy, we have plenty to talk about this week. I mean, it was just so many dramatic things that both reinforce what we teach, as well as the kind of things that can scare people, or what. I mean, it was just, there's a lot of news.
Yeah. Oh, yeah. Well, I mean, I have to change my joke. I was saying that, what do you call a 1/3 drop in the value of Bitcoin? And I said, good start. Now, what do you call a 50% drop? It's right. a really good start. I have to, it is funny because there was an article in some publication. I can't remember where the heck I was reading. I think it was Market Watch. And they were talking about how these people, I hate to call them investors. When people talk about people buying Bitcoin, they call them investors. I'm like, oh, it's not an investment. By definition, you've got to have somebody paying to use your money, either paying interest or paying earnings or paying rent or, paying something to use your money. When you have something that just goes up and down in value based on supply and demand, that's not by definition an investment. But that's what, they call these people. They call them investors and everything. So often I'm just going, can we change the terminology?
Right.
It's more like collectors or something like that. I don't know. I don't know if there's a better word that can be used.
Hoarders.
Anyway, the whole thing about the Bitcoin going down in value, but their investors, quote unquote, or people, collectors, or whatever we want to call them, were doubling down and saying, we're not giving up on this. And all I could think of is the psychological concept that you have sunk cost fallacy.
Yes.
The idea that if I put money into something and it has gone down in value, it's really hard to get rid of it. It's really hard to just say, okay, I lost. Let's cut bait and let's run.
Yeah.
Psychologically, it's very, very difficult because basically you're saying that, okay, this was a mistake. Maybe that's part of it. But the other part of it is that, and this happened, I remember when I first started the show in 2001, it was next to impossible to get people to get rid of or let go of tech stocks.
Right.
And, they would lose and they'd go, it's just coming back. It's coming back. And I'm saying, so you're basically thinking that somebody is willing to pay you a large sum of money for this thing that went down in value. And that they're thinking that is, because you're thinking it's going to come back, somebody's got to pay you what you paid for it.
Right.
And the reality of it is you lost the money. It was valued at a certain level. And then when information came out that told us that those expectations aren't going to happen, earnings expectations aren't going to happen, then all of a sudden the price went down to what it should be selling for. So that is a really hard thing to get people over. It's really challenging to get people to overcome this idea that maybe it wasn't a good idea and maybe it was a mistake. And admitting mistakes is just not something that people are great at.
Yeah, I think another thing at play in that, maybe not so much with the Bitcoin, just because it's relatively new, there's not a track record of other failures long term, plenty short term. But on the stock side, when you're talking about tech stocks, there's also an element of survivorship bias in investors looking at that, because a lot of people were looking at the fact that, say, Amazon in the 90s had several 50% drops. And then it came back, and it came back, and it came back.
Yeah.
Well, there was a ton of companies that went under and never came back, but you're holding this stock that's down. You're like, well, it could, come back like Amazon did. And you start to carry that over and think, well, they all recover. And that's just not true.
Yeah. That's a really good point. And, but there it is. There's the article. Bitcoin's 50% plunge from highs hurts a little. I love that headline. It hurts a little, but it isn't shaking these investors' conviction. And I'm like, well, what will? I don't know what will. But
those are the same people that say the world is ending when the stock market's down 10%, or something. That hurts a little. It's 50% off.
Yeah, it hurts a little. Longtime Bitcoin holders are used to its volatility, and that's kind of like you said, because it did go below like 30,000. I remember did that, and it came back. But the reality is that you don't know. You can't predict when it's going to come back. The only thing that makes it come back is that people, just long-time holders decide that they're just going to start buying and they're going to push it up, or somebody's going to come in and demand is increased.
Yeah.
But there was somebody talking a little bit about that, and we'll get to that. There was some really interesting stuff on the media about that. But one of the things I wanted to hit early on here. Now I'll tell you what. Let's hit this, because this was a topic of conversation right here. Let me play this little clip right here.
Check out Bitcoin this morning as well. The cryptocurrency coming off a 13% plunge yesterday, worst 24-hour drop in about 4 years. Nearly broke 60K overnight, but that is where it bounced. Yeah. Jim, a lot of discussion about Fibonacci levels and sort of questions as to why it's not rallying when so many fiat currencies are being questioned.
Okay. I mean, when I talk to people about the end of Bitcoin.
Okay, so fiat currency is like the dollar or the euro, or something that's not backed by anything specifically. They say that, but I am going to argue that it is backed by something. I don't know if, Evan, you've ever heard me say this, but the reality of it is, when you say the dollar isn't backed by anything, it used to be backed by gold, and that was the idea. Now it is technically backed, because what is the job of the Federal Reserve? What are the dual mandate of the Federal Reserve?
Monetary policy and inflation and
full employment. Full employment. Yeah, right. Exactly. And inflation, making sure that the stability of the dollar is the idea. Okay, so when we talk about the stability of the dollar, how do we determine that the dollar is stable? What is the criteria for determining whether they're getting the job done right? Is if inflation is in check. Now, how is inflation actually calculated? It is calculated by looking at the increase in price of a basket of goods. and making sure that the increase in price of that basket goods doesn't exceed a certain level. Now, it's an imperfect process because you've got to look at what people typically buy.
Right.
You'll have, rents in there. You might have eggs, and you might have food and clothing. You might have electronics.
Gasoline.
Gasoline. There is a whole host of things that are actually looked at to determine whether inflation is in check. Now, if the price of those things is not going up too much, or it's in check as far as not being up more than 2% is the goal, but 3% is kind of what we've been dealing with, then the Fed is considered to be doing their job. Now, here's the thing. If all of these things, everything that Evan and I just named, just name anything that might be a basket of goods that you typically buy. If that is staying stable as far as the price of it not going up too much, you have basically backed the dollar, not with just one thing, gold. You backed it with hundreds of things. Rents, electronics, cars, just anything, computers, anything that you might buy. This is actually backed by all of these things. Now, this is something that you think, oh, well, wait a minute. It is sort of backed by something if you think about it in that way. Now, so that's what he's talking about with in terms of a fiat currency. But let's continue.
We thought it was going to be a protection against a weaker dollar, and it went the wrong way.
No, we thought it was going to be a protection against the weak. Who's we? Yeah, not me.
Right.
it wasn't Evan or I sitting there thinking this is going to be a great idea. But we thought. I thought, well, how often do you guys in the media need to be wrong before you finally just go, maybe we don't have this thing down? But that was the point right there.
The story that I'm believing best, and this is one they report next week, and I think you're going to hear it on the conference call. I think you're going to hear that Ammar al-Jundi, who's the CEO of Agnico, has said that the gold flows from, they actually have demographic and age, younger people out of crypto into gold, David.
So that's the premise now, is what's happening.
Well, to me, the word that jumped out in that last quote was story.
Yeah, the story.
The story I'm believing, not data, not
that's a good point.
Academic research. Like, well, yeah, okay, it's a good story.
Yeah. No, that's a really good point. It is. It's like we make up something and this is
the story your kids tell you, a monster sawed the legs off the chair. It wasn't me. Okay, got it.
That's funny. So he's talking about where money is flowing, and if it's flowing out of Bitcoin into gold, and that's driving gold up. What did it flow out of to flow into Bitcoin that made Bitcoin go up artificially for a while, and now it's starting to go down? Yeah. And will the same thing happen with gold? Just conjecture, right there.
Well, then I don't know where the incremental buyers are coming from. They're showing up a little bit today.
Well, they're selling the S&P futures so they can buy.
You did say that they leveraged what? They leveraged the S&P to buy Bitcoin?
Yes, they did.
So one of the things that he just, exactly. I mean, you leverage, you're borrowing money to invest in something. So what I think is interesting right there is if they're pulling money out, he's saying they're pulling money out of Bitcoin and going into gold. And David is basically saying, no, not necessarily. Not necessarily. I think, matter of fact, let me continue because I think he says it. Let me hang on.
They didn't want to sell their Bitcoin, but a lot of them got blown out. We got to a level.
And then there's.
See, there it is. They did say it. Okay, cool. So if I sell Bitcoin to buy gold, that drives up gold. And he's saying, well, no, they're not wanting to sell their Bitcoin. But what they're doing is they're still investing. They're just changing where they're investing. They're investing in what went up.
Right.
And it's like you're chasing the horse after they got, you're closing that gate after the horse has gone out, and you're chasing something that did well yesterday.
Yes.
And making a different mistake or the same mistake with a different thing.
Yes.
Is really what's happening.
Yeah.
Michael Saylor at Strategy, formerly known as MicroStrategy, obviously the Bitcoin company that started the whole Bitcoin strategy, that still has this credit product called a stretch.
And he's out there still defending what he's doing. And this guy was interviewed all the time, and this is going to go to the moon. It's going to be great. It's going to be the best thing ever. And Saylor, when you think of fundamentals, Evan. When we talk about the fundamentals of a company, what are we talking about?
Well, you're talking about the accounting data of what are their earnings, what's their inventory, what's their turns of inventory, what's their gross margin, what's their earnings before interest and tax. The hard data of what's creating profit for the company.
And what creates value and what determines the cost of capital that we always talk about here. Now, exactly, when you hear the word fundamentals, that's what we're talking about. We look at the fundamentals of a company. Now, there's something called fundamental analysis, which we heartily disagree with. And the vast majority of investment firms, if you look at their ADVs, I haven't found one yet that doesn't have that they use fundamental analysis in determining what to invest in. Yeah. It's a waste of time. And the reason, you look historically at it being a waste of time. Why? Because everybody knows that information. Everybody knows, everybody can find out what the cash flows are, what the earnings are, what the expenses are, what the plans are for the company in the future to analyze the fundamentals of a company to try to determine whether it's a good investment or not is a waste of time. And we know that because 90-something% of professional managers fail to match market returns. It's a waste of time. And, the reality is you don't have to do that junk to be a successful investor. So fundamentals, the idea of fundamentals, it's what gives a company value, as Evan pointed out. But check this out.
And then there's Michael Saylor at Strategy, formerly known as MicroStrategy, obviously the Bitcoin company that started the whole Bitcoin strategy, that still has this credit product called a stretch that they sell. Yeah, that yields 11.25%.
So it's yielding 11.25. Who wouldn't be attracted to investing in that
rate environment? Yeah.
Okay, so who wouldn't be attracted to that? But listen to what it is.
At least paid monthly tax deferred. They told us not
to worry about that.
Yeah.
Well, they do have a couple bills socked away.
They had their earnings, and Saylor, as you might expect, was answering a lot of these questions involving, what happened? Yeah. Take a listen.
Strategy is based upon looking at the fundamentals and taking a 10-year view. And so when you consider the fundamentals of digital capital,
that's all you need to hear. The fundamentals of a commodity?
Right.
Are you kidding me? What are the fundamentals of a tube of toothpaste? What's the fundamentals of, a piece of artwork? What are the No, it doesn't apply. There aren't any. When I look at it as something, a collectible that can go up and down. What's the fundamentals of a Beanie Baby?
Right. Yeah. Pure supply and demand. So
exactly.
This may end up becoming like the first half of the show, but that's the biggest thing I was thinking about. Thursday, Friday, the big drop on Thursday, and then there's a recovery on Friday in the digital space, both Ether or Ethereum, whatever, and Bitcoin and so forth. And thinking there is nothing that should be moving Bitcoin. At least silver has industrial use. Okay, there's an increased demand for chips. Yeah. Okay, there's a price. There's a reason for the price to move. Or gold. Yeah. It has uses, all those kind of things.
You could have another thing drive the price up. Very good point.
And,
yes.
Trees, coal, whatever. But Bitcoin, it doesn't pay interest, so it shouldn't be interest rate sensitive. There is no dividend, so there's no earnings. So it's not like, earnings went down. We're not making as many Bitcoins this month.
Yeah.
It's just ones and zeros, and yet it still behaves like this radical investment. I mean, it really makes no sense to me whatsoever.
Yeah, and I think what happens is people become euphoric to see the stock market go up, and they buy more Bitcoin as if it's somehow related. I mean, it is very, very odd.
Yeah.
You have to start with the most important regulator in the entire world.
So basically saying what would drive Bitcoin up? The most important regulator in the world.
And that is the president of the United States. We have a Bitcoin president, and he's intent upon making America the Bitcoin superpower, the crypto capital of the world, and the leader in digital assets.
So it's not a fundamental still, but here's the point he is making. Is the reason for his optimism is you have somebody that supposedly is behind this, and the reality of this person won't be in office forever.
Right.
And at what point in time is the writing on the wall that maybe the next person to come along isn't going to be so optimistic, and you can't get the heck out of Dodge fast enough on these things?
I don't think you can underestimate the importance of having support for the industry and digital capital at the very top.
I think you can. I think you can underestimate it. I think that is just plain wrong. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. We're back here on the Investor Coaching Show. Paul Winkler, along with Evan Barnard. Okay, so one of the questions that came up on News Channel 5 Plus when I was on there on the open line, guy was asking about an ad that he'd seen. He says, Paul, have you heard about Yrefy? And I said,
fun.
I said, I really don't watch a whole lot. I mean, I got cursory watching of TV here and there. CNBC, I'll check it out in the morning just to see what's going on in the financial channels, just to see what kind of heresy is being taught out there.
Yeah.
But, other than that, I really don't pay a whole lot of attention to things. And I said, explain it to me. Kind of tell me what it is. He goes, well, basically, you got student loans and, these people that they refinance distressed or delinquent defaults, private student loans, and you can get a 10% rate of return, and it's guaranteed, blah blah blah. And I said, whoa, wait a minute. I said, early days of the radio show, this guy calls in and he says, hey, Paul, what do you think about tax liens? And I said, and I didn't, quite frankly, I mean, this is 25 years ago, I didn't really know what they were.
Yeah.
I'd never dealt with them at all. And I said, well, explain them to me. I did the same thing with him. And he said, high rate of return, no risk. And I said, hey, here's the deal. If there is no risk, I don't have to pay you much to use your money. If you're not putting up with anything, as I like to put it,
right,
I don't have to pay you much. It isn't the wealthy person that pays high interest rates when they borrow money. It's the poor person that may or may not be able to pay back the loan.
Right.
That's the person that's going to pay a high interest rate, right? So I said, I'll look into it. And I said, I'll talk about it on the radio, but not necessarily buying that this is something that's going to be legitimate. Well, I did do some research on it.
Yeah.
And some of the guys here in the office helped me out. Chad helped me out. And what they found was this. It was interesting. There was an article entitled Fox News Channel, Yrefy LLC and the state of Massachusetts.
Oh.
Anytime you get the state involved, that's probably not a great thing.
Yeah.
On February 3rd, it said 2020, state of Massachusetts did the unthinkable. In a rare provocative move to protect investors, they filed the complaint against Reg D promissory loan note company Yrefy LLC before its inevitable implosion. So over 6 months ago, we issued a report, a private student debt refinancing company that also promised investors a collateralized investment opportunity, according to its offering materials, if investors commit for a 5-year hold period, they can earn a rate of return of 10.25%. So that was the claim, and that was what this guy was saying, what this guy was asking me. It says... It said instead of the companies rely on imputed credibility between 2024 and then they're going through. They said that reports on Yrefy LLC spent $5.4 million on national television ad buys, another $348,000 on radio ads from December 2023 through December 2024, all to recruit accredited investors. Those are people that the government deems able to lose money, because they basically go,
which should tell you something.
Yeah, exactly. It should tell you something. Those are people with enough wealth that the government's like, if you lose, a few $100,000, no big deal. You'll bounce back.
Yeah.
This is a Reg D multifamily equivalent of New Deal or off the market or below market value opportunities. Worse still is the amount paid to individual media personalities. One such personality received $746,000 on top of ad buys to pitch Yrefy's investment opportunity, this article says. To date, Massachusetts records indicate that Yrefy LLC has paid 17 TV personalities. And then a lot of times, I'm just going to tell you in general, when you have these types of people and they really don't know anything about this stuff.
No, they're picking up $750,000.
Yeah, I feel bad for them, as a matter of fact. I see these celebrities, they're pitching insurance company, asset management and things like that. And I just go, if they only knew what these people were actually selling, they would probably be mortified if they really, really knew.
Yeah. Well, the interesting thing, because you don't spend as much time in the culture sphere, is we both know one of those promoters. And he's a good friend of somebody else we know.
Okay. I won't ask. All right.
And, like another one is Larry Elder. I mean, it's really interesting. And when I first saw him promoting that, and then I started looking through, because he knows what we believe in, it really surprised me.
Oh,
but to me, it speaks to your point of they're not really investigating this to see how safe it is, how valid it is.
Right.
They're just, it could have been Coca-Cola or Yrefy. Doesn't matter to them.
Well, it's a good friend of mine. He was in the media world and goes around, and he and I have been friends for a long time. But he goes around. He used to go around the country a lot more and teaching financial things. And basically he talked about being in the media world and talking to Paul Harvey. He wanted to have Paul Harvey actually recommend a product or be an endorser of a product. And he said, this is how unusual this guy was, Paul Harvey. He said he took his client from Nashville all the way to, I think it was Chicago, where Paul Harvey was, where he was.
Okay.
And he wanted to have him look at the product. And Paul Harvey looks at it and he goes, I'm sorry, fellas, I cannot get behind this. And he said, I was disappointed, because I really wanted him to be a spokesperson for the product. And he says, and I don't remember the time frame, but it wasn't that long after that there was an implosion. In the product. Yeah. And Paul Harvey was dead on right. He actually saw right through. Yeah. And he was just talking about how it was just how admirable that was, that you had a guy that was so concerned about what he was talking about and what he was endorsing, that that happened. But anyway, aside, in the YouTube video, he said, this guy says I outline the averages on the loans we make to our borrowers. The interest averages about 3.9% with average terms of 8.6 years. The highest interest rate we charge our borrowers is capped at 5.19. Now, this is an investigation where they received an email from this person from Yrefy, and this is what he's saying. This is from a quote from him. It says, highest interest rate we charge borrowers is capped at 5.19%. It would be a larger loan size, typically 20-year term, blah, 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 blah. This paragraph I thought was telling. Later correspondence confirmed that 90% of investors chose the 5-year note, which pays 10.25% annually. This raises a critical question.
Yeah.
How can Yrefy LLC pay 90% of their investors 10.25%, cover overhead, including salaries, and fund 17 media personalities when the maximum interest from their loan portfolio is capped at 5.19%?
Yeah.
Even this average interest rate were double, the company could not cash flow. And let's not forget the $750,000 fine paid to the state of Massachusetts to settle charges that they did not admit or deny.
Gosh.
So
maybe it was 10% for all 5 years.
I don't
Maybe
know.
it was 2% per year was what they were promising.
Yeah, I don't think so. I don't, that was
No,
not,
it wasn't.
no, definitely.
Yeah.
But here's just the point.
Yeah.
Anytime somebody tells you that they're going to give you something for nothing, that there is return without risk, just run. Don't walk, run.
Right.
There is no such thing as a free lunch, and yet it sells and it appeals to people's desire for that to be true. I would love to have something out there like that, but let's just face it, it doesn't exist. Nobody's going to pay you more than they have to use your money. Bottom line. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.